India is no longer the people who sit in a Bangalore, Delhi, or any of the metros for that matter. There's a lot more to India once you get out of these particular cities. Founders have gotten far more demanding. Founders have become VCs themselves. DC entrepreneurs have now become a real thing.
I think founders are realizing that they don't need as much capital to go build a good sustainable business in India.
They are now demanding from VCs, what can you bring to the table besides the money that you bring in?
Okay, so it's that time of day at TechSparks, so we cannot do without a panel or two on what VCs want. So, let's get down to an interesting conversation. Just to set the context as well, over the past 1 year, we've been talking about a startup funding winter. 2023 was all about a slowdown in momentum, a shift in investor paradigm. There was, of course, heightened caution and a couple of down rounds as well. And now we're finally seeing some echoes of a landfall of, a spring or a reap season in a sense. We've seen some validation from some big ticket IPOs from, the digital native and the new age economy. So some validation there. But with that said, let's really talk about what are Indian VCs betting on now. And for that, we have Siddharth and Shanti with us. So my first question to you, and, Siddharth, you can start. We've seen all these IPOs, that have been listed from the new economy space. Would you say that India as a startup ecosystem has completed that 10 to 15 year, venture capital to IPO cycle? We've seen some secondaries, we've seen some validation, and now there's a shift from just pure valuation to profitability.
So I think the biggest question that the Indian startup ecosystem grappled with for the longest time was, where are your exits? We've been fantastic when it comes to having a large market. Your per capita GDP has actually crossed $2,000. Digitalization has become the norm across the entire country. 900 million plus cell phones connections, etc., for that. But every foreign investor, every LP, every asset allocator said, where are your exits going to come forward? And there was always this preconceived notion that the Indian public markets would never accept a loss-making or a cash burning company. But Zomato was a pioneer that actually proved it wrong. Traction actually came in, turned profitable, started building sustainably thereafter. We've seen PB FinTech. We've seen a number of people end up actually proving the sort of paradigm now. Now, Swiggy is going to be the next watermark to end up actually coming, because Swiggy is going to be a multi-billion-dollar IPO, somewhere between $8 to $10 billion, a large offer for sale. Capital is going to get released and recycled back. And even during the entire funding winter that's actually been there, I think investors were never shy about the India opportunity. They just found the valuation a little too rich. But I find it a little condescending that they looked at a poor country and said, oh, you have rich valuations, what actually gives? We've seen in the US, so many AI companies who are just wrappers on ChatGPT raising a multi-million dollar valuations. It's absurd. But what we're finally seeing as of now is no longer contingent on as much foreign capital coming in. Indian VCs have actually raised record-breaking amounts of capital in 22-23. And with the cycle of IPOs are going to start off as of now, that capital will get recycled. It'll validate the fact that India is still the home of exits. India has now become the home of exits. IPO is a fantastic opportunity. And every boardroom that I've been a part of, the question they ask the founders now no longer, what is your revenue, what is your part to profitability, but what's your part to an IPO? And the IPO is actually dominating the entire game. We have reached an entirely new paradigm. And I, for one, am actually very glad to end up seeing that.
That's great. Shanti, your views on, the current state of the startup economy. And also, we have IPOs on one end. Not everybody can really IPO. But overall, as an investor, what are you seeing? Is there a reset? Where really does the bar stand?
Oh, absolutely. So I think there has been an absolute reset, like what Siddharth said, in terms of valuations. I think people don't want to pay a very high entry price when they actually invest into companies, because, the path to IPO, it's not like every company is going to the path to IPO, right? So probably 2% is probably getting to IPO. But I think there are a lot of smaller companies which are now looking at how do I continue to sustain without the need to raise capital and become profitable, right? So what I call it is, it's not a choice between profitability and growth. It is profitable growth, right? So, both of it has to come together. And what is interesting to see is that I think our founders are very, very innovative. They are very smart. And I think the adversity of the market, of COVID and then slowdown has shown that, founders can really find a way out if they need to find the way out, right? And that I think has now produce better founders. I think when we look at early stage presentations, I think people are talking about revenue very early on. They're talking about business models early on. They're talking about product differentiation. And like what Siddharth said, it is not about just creating a wrapper and saying that, I'm going to build the next innovation. I think there is innovation, a lot more innovation happening today, which is basically then leading to better companies. And I think we are just starting to see the beginning of a much better, mature ecosystem.
Sure. And, we'll talk about how startups and founders are becoming more mature, but, also your views and Siddharth on the VCs themselves. Are you seeing them maturing a little bit more now in terms of, the resilience and the challenges that they have seen? And some VCs also looking at, setting up profit threshold in investing. Is that the right way?
No, 100%. So the best way to answer that is VCs have gone from looking like the fathers and grandfathers of founders to actually looking like founders themselves. I think that actually shows the kind of paradigm shift we've seen happen in the Indian investing class also. For the longest time, the way to actually get an Indian VC's attention was to say, I am the Indian equivalent of this foreign company, of something in China, of something in the US, or what is hot in China is going to get hot in India. Let me try building towards that. No one really cares about that as of now. Any company which starts as saying, I'm the Uber of X, is automatically going to go to spam or say with a canned response saying, thank you, this is not a focus area. They finally now understood that India is no longer the people who sit in a Bangalore, Delhi, or the metros for that matter. There's a lot more to India once you get out of these particular cities. And the founders who are actually tapping into that opportunity and the VCs who can actually travel there, get out of their business class seats, get out of the Vistara premium economy cabin, actually take a train and go there. They're the ones who are actually finding these kind of deals. There are now, I've actually similar to how bankers used to go to like the villages in a suit. There are now VCs actually going there, taking away their suit, trying to wear a kurta. They're like, I've been buying this for a long time, much before this entire trend has started for that matter. But that's actually going to show that VCs have realized that the older playbooks have actually gone away. And the competition we've seen in venture capital is tremendous. We have 1,000 odd AIFs in the country as of now. There are numerous micro VCs who are actually beating full-fledged VCs and established shops in terms of the term sheets that they actually give. Because founders have realized the color of the money is the same. Whether I get $100 from, let's say, a SoftBank, or whether I get it from the person who's actually down the road, I'm still getting the $100. They are now demanding from VCs, what can you bring to the table besides the money that you bring in? So we're seeing operators actually come in, people who have actually been previously bankers, people who worked as professionals as CAs, etc., come in. And that diversity is allowing them to find different kinds of talent to end up seeding them, support them in ways that go beyond the check that they actually write. A VC can't be a mutual fund investor. Cut a check, say, very nice, have you done well? Come back, talk about some gyan they heard on the All In podcast the previous day or read on Twitter. Founders have gotten far more demanding. Founders have become VCs themselves. VC entrepreneurs have now become a real thing. It's no longer which banner name in the US you managed to convince to actually give you a franchise in India. It's what franchise have you built by yourself? And that's fantastic for the ecosystem. We've seen all this happen in 10 years. The number of VCs who've shed their US or their foreign tags and actually embrace the fact that they become entrepreneurs themselves is large. And we're seeing all that capital be managed from India, in India, by Indians to invest into India. You can't be a helicopter VC anymore. Someone flying in from New York once a year or to come in for a Your Story event and say, look, I believe in India, go have a masala dosa, walk in Cubbon Park. Those days are gone, my friend. Those days are completely gone.
Yeah. It's also great to see how the tables have turned in a sense. Founders are spoiled for choice when it comes to, pick your VC kind of a thing.
There's actually a scarcity of quality assets. This is fantastic. We have too many VCs, a lot of money, chasing very few assets. The power is finally back in your hands once again. Prove us wrong, make a lot of money, let that virtuous cycle end up continuing.
Yeah, right, capital is not a differentiator anymore.
True.
I think you have to go beyond capital even as a VC. And I completely agree to what Siddharth is saying there. Because every VC website you see today, they will actually tell you how they are different from another VC. So when I talk about product differentiation as a founder, even venture capitalists and the capital providers have to talk about how are you bringing more to the table beyond capital.
True. And, even in terms of, what do you prioritize as a high potential asset? Where as a VC, when you're investing in a startup, that becomes an asset. So what would you categorize as a good asset?
It's always team. It's always the founder, right? Because, and in fact, it's a very interesting story. Yesterday, we were evaluating a company where we just committed today morning. And the market size is not so big, actually, what he's building on. And then we actually spoke to the founder. But we loved the founder's understanding of what he's trying to build, his aspiration of where he wants to go. and just the depth of how he's thinking through it. And he very quickly acknowledged that he knows that the market is not big enough, and he knows that he's trying to create a hook into a much bigger market. And I think those are the kind of founders you want to work with, right? Who are also willing to have a conversation and be comfortable with differences and not start saying that, I don't like this conversation because you're asking me too many questions. So I think early stage, actually, it's only about team, right? You have to double index on founder. You have to kind of bet on somebody who deeply wants to solve the problem, who deeply understands the problem, who is actually able to think through the differentiation on the product, but also a big enough market, right? So it can't be a very niche market you're trying to address, because that will then hit the barrier as you start to scale.
So that your point on, what would you consider as a good asset?
No, so see, early stage is not about stock selection, it's about new asset creation. Okay, so you need to have malleable enough clay to end up actually working with. So what do I mean by that? First and foremost is team, of course, I agree with Shanti. The greatest risk you have in investing is not regulator risk, RBI waking up one day, credit risk, government, Nirmala Sitharaman changing something, etc. It's actually people risk. It's whether when the shit actually hits the roof, can you trust this founder to pivot? Can you trust him to make the kind of hard choices that are there? That becomes one. Number two, is the founder frugal? Frugality actually breeds innovation. The moment you end up overstuffing a company with capital, he will just hire an army of consultants, go poach from some other overpaid organization and pay them double the salary for that matter, and actually just squander away all the cash that's actually there. A frugal founder is actually the best because they respect the capital that comes in. I think from 2018 all the way till about 2021, founders in India lost the respect for capital. They just thought capital is an infinite money tap that will keep coming to them and it goes away. The third part is, I would say, there's innovation, everything. I would say differentiation. Differentiation is important because so many companies, I am working in this consumer space, I'm trying to do this kind of thing, and you're the same from every other company that's there. How do you end up differentiating? And the last part, I think, is important. It's actually awareness of your business. What I mean by this is, especially in the early stage, you get 100 customers, you're like, oh my God, I have 100 customers, this is great, I want to be valued at like 5 million, 10 million, 20 million. The moment you start valuing yourself from crores to millions, you need to have a track record that actually proves it. Don't extrapolate short-term trends and believe it's actually a long-term phenomenon. It doesn't work that way. And a lot of people end up actually making this mistake. So know when to raise capital. Don't write to a VC immediately and say, oh, I just started to have an idea, give me funding. A VC is not here to fund your dreams and your aspirations. A VC is here to fund a business where he can underwrite a much larger outcome. So understand when to end up raising capital, where to end up raising capital. And if you have these mixes, doesn't matter what space you operate in, whether it's even space tech for that matter, biotech, whether it's consumer, fintech, even edtech as of now. There are very innovative assets coming out there. It really doesn't matter. You just need to have a founding team and a management team that can make it work. And every VC will end up actually chasing you. We have a company called Dhan, who turned profitable. The person's valuation, the person's revenue is more than his valuation as of date. He refused to raise for a long period of time for that matter because he said, why do I need the money? That's a fantastic place to actually be at. That's true independence. And that's what a founder should aspire for. Your valuation is vanity. You can ask a friend to give you 100 rupees and give him 0.00001% of your company. You will be valued at about 10,000 crores. Does that mean you can liquidate your shares at 10,000? Of course not. Yeah. So your valuation is vanity. Look at the reality of how much cash you can actually generate. Seek independence. Be Atmanirbhar. Lead a fantastic life. And guys in suits and in kurtas will end up actually chasing you after. Isn't that the place you want to be?
Great point, Siddharth. And like you said, valuation is vanity. This chase for, unicorns, and now reality has finally struck.
A number of our unicorns have become popcorns. Come on, dude. It's a transient phase, okay? Where's a company that can generate $1 billion of revenue or $1 billion of profit? Zerodha came close, 4,500. That's fantastic. $1 billion of revenue, 57% margin. Those are the guys we should be chasing. And he can value himself at whatever price he wants. He's in fact valued lower than some of his listed market comparables or others who are actually there. That's the true hallmark of an entrepreneur. He's free. Ultimately, isn't that what you want to be as an entrepreneur? Free. Not have to be answerable to anyone. So get rid of those shackles, man. Just end up working better and end up doing it far better than what you're doing as of now. Raise the bar after all. That's our motto as well.
Right. It's great to hear, such straightforward talk. Let's talk about the quality really of this asset now, as well as the demand and supply side of things. So a two-pronged question here really. When we, do you really allude to the fact that there was a funding winter? And was it fun? Because, what we hear is that a lot of VCs have been sitting with dry powder. there are so many VCs, AIFs, founders starting their own, funds. So there's a lot of capital out there. Is the problem then the supply of, quality founders and startups? And are you now also looking at, second time, third time founders? What really is the story out there when it comes to the quality as well as?
I go first, or I think Shanta, you can go.
Yeah, you can
I'll go
start.
first, sure.
Shanti.
See, I think, listen, so capital has always been in abundance. There's never been a scarcity of capital. What has happened is there's been a valuation mismatch. I think the valuation mismatch is very simple. In the 2010s, we had zero interest rates in the US. Indian entrepreneurs and founders are the only ones who will ignore any statement made by the RBI governor about rate increase, etc., because it has no bearing on their life. But the Federal Reserve threatens to cut rates by 25 basis points. They all suddenly become a macroeconomist for that matter. But in the US, for the longest time, we had zero interest rates. That zero interest rates meant that the value of a dollar today is the same as the value of a dollar tomorrow, 2 years later, 5 years later, 10 years later. And VCs there realize if you could borrow at zero at, let's say, 50 basis points or 100 basis points, and if a company needed, let's say, $200 million over 10 years to scale, screw it, I will wire $200 million to him as of today, allow him to end up actually scaling that out, and use capital as a weapon and as a moat to prevent anyone else from coming into that space. That was the thesis. That was how Masa from SoftBank raised $45 billion in 45 minutes. Simple thing. He said, this is the era we work in. Technology is the future. AI is great. Give me the money. I will end up, what would happen in 50 years? I'll make it happen in 5. I mean, he's had some reasonable degree of success and failure for that matter. But that life has changed now. Interest rates have risen. Investors can get 5.25% in dollar terms risk-free by buying US Treasury bonds. You imagine the return you have to deliver on a portfolio basis to end up actually competing with that. Fixed market instruments in the US have gone up to 8-9%. FDs in India are 8-9% in rupees. Look at the dollar differential that's actually coming in. So investors said, I don't care about growth at any cost as of now. I need to see the ability for you to generate cash flow today. And a number of business models, unfortunately, didn't have that ability. And that's where we've seen the mismatch happen. So VCs have sat on the money, they're patient. They'll happily buy US Treasury bonds in the US at 5.25, sit on that money and wait. And it became a game of brinksmanship between founders and investors. VCs wanted a better deal. Founders refused to give a better deal because they wanted that high watermark valuation. And companies have tanked because of that. The smarter founders raised at a down round, bit the bullet, and now we're actually building up. And now we'll start looking to an IPO, looking to exit, looking to start creating value. So money was always there. It was the funding winter happened because founders got greedy and they looked at the old days of the 2010s and said, I want to go back to that. You have to be a unicorn, not an ostrich. You can't bury your head in the ground and say, this is the new, and actually say, I don't believe this is reality. The new reality now is that no one expects 100% growth year on year. You can show 50, 30, 40% growth for that matter. And if you're profitable, it's great. HDFC Bank, a large lumbering giant, creates a Kotak Bank in terms of deposits every quarter. Do they care about growing 50% year on year? God no, the base is so high, even a 10, 15% growth is magnificent. That's the kind of businesses we're actually competing against. That's the kind of businesses that are competing for the money that will end up coming to you. So you need to have a damn good reason to convince an investor, any investor, why they have to take a bet on you when they can bet on these kind of companies that have had a history of actually compounding that consistently. So I think that realization's come into the market now. Investors have become far more frugal. Founders have become far more judicious about the way they end up using capital. I think that bodes fantastic for us. We will see a far leaner, meaner, more efficient startup ecosystem end up actually coming forward from 2024.
Yeah, but just to add to what Siddharth said, I think this is a problem and a solution created by the VCs themselves, right? Because if you look at 2018, every VC said, go grow, raise more capital. And then suddenly the same VC is saying, don't, go throw money, come and kind of look at profitability. So I think, this is a problem which is almost like within the ecosystem, right? Because I think the basic fundamental of building a company doesn't change, right? And I think people were watching Zomato, and like what Siddharth said, I think that was the bet which everybody took, whether can a loss-making company actually go list, right? And that was actually a moment of realization for a lot of people that after that, once you are in the public markets, you have to finally turn profitable, right? You can't be with negative numbers for a very long time. But I believe that, the basic of building a company has never changed, right? It is just that the narrative around it has changed. And I think VCs like to change based on how the markets are kind of also behaving globally. And I think today, like I said, I think we have a lot more mature, better ecosystem because I think people are realizing that, you know, at the end of the day, you have to build sustainable companies. But I think more important, I think founders are realizing that they don't need as much capital to go build a good sustainable business in India. I think that realization, and I see that in a lot of our portfolio founders who reach out and they say, I can't give you an exit, but I'm profitable today, right? Because they have raised at a much higher valuation. And if they try to exit, there will be drag along, there will be all of the other, you know, liquidation prep, all of that will kick in, which will not allow the founder to make any money at the end of the day. So founders are saying, I don't want to give anybody an exit, so all of you can wait while I'm building this profitable company. So I think there is a kind of a lock situation also happening in a lot of companies, right? Where there is no way out. You have to just wait for things to probably become.
Isn't that the
way
VC
better.
game to sort of play it long term? I mean, how do you look at it? You know, like what should you know, startups do to keep you happy? Because everyone can't go for this utopian IPO
Build a good
exit,
business.
you know, like, and
See,
do VCs have to be wedded to?
No, see, that's the thing. A VC is an investor. When you invest in mutual funds and the company is doing bad or invest in a company in the stock market, do you sit and hold on to the stock and pray? No, you exit. That's it. I think that's what you need. You can't have a Hotel California situation with your investors. Easy to get in, impossible to get out. It really doesn't end up working that way. So to every founder who's there, the simple message is this: build a good business, the VC will actually come to you. Yes. As simple as that. You build a terrible business, you have to market it, come out with all sorts of mental gymnastics to end up actually selling your business, selling your idea, selling everything. If it's not simple enough to end up actually selling, it's not obvious over there, either there's something off with the business or there's something off with your ability to actually communicate that. So work on that. See, VCs are investors. We have a portfolio approach. We can have 5 companies that tank in a portfolio of 20. So long the remaining, and another 10 who will do mediocre. The 5 who make it will end up absolving all the sins of the past. Make sure you're part of the 5 that does well, not the mediocre set or the part that actually tanks. If you build a good business, that's it. You have the greatest amount of freedom.
And I think that we don't need to judge a VC just because they're saying, I need to find the next unicorn, because I think that's the business they are in. Like what Siddharth said, they have to return capital back to their LPs also, right? Like just like how founders have to return back to their investors, the fund managers also have to return capital back. And I think that is the ecosystem we are in.
It's extremely easy to find a unicorn. You find them on a Your Story panel, or you find them on the pages of Your Story as well. It's very hard to make a unicorn.
What do you have, you know, on your portfolio? So do you have 4 unicorns on your, you know, portfolio?
And all of them
right
have
now?
publicly stated that they wish to list in some time, which is fantastic. It's music to my ears, for that matter.
Great.
Which is
But, you know, tell us about your thesis at 314. You're largely into fintech, SaaS and consumer play as well.
So the short story is we're into any business that has the potential to end up actually becoming a multi-bagger. It's as simple as that. We've done deep tech. We've had fantastic assets in deep tech in semiconductor before semiconductor became a buzzword for that matter. We have companies in fintech. We have companies across. So as you said, our thesis is simple. If you can prove to us that for the amount of capital that you are raising, the market is large enough for you to end up getting a dominating share or a decent enough share for you to end up generating returns, number 1. Number 2, if you're a founding team that can actually roll with the punches and you can end up actually delivering value, regardless of what happens to your business, that is actually number 2. Number 3 as well, for that matter, you're in a business where capital is not the only differentiator. Then it becomes a question of not how good you are as a founder, how good the space is. It's how effective your competition is in terms of raising capital. We've seen in EdTech where at one point, the valuation of the top 3 EdTech companies was 3 times the value that PwC ascribed to the EdTech market in 2025. Now the question was, were the EdTech companies overvalued or was the EdTech market undervalued? I think the reasons actually become fairly apparent as of now. So you need to be in a situation where the ability to end up actually raising that kind of capital, or when your competition can end up raising that capital, you have to develop the same kind of skill set itself. I think if we have these 3 sort of matters, doesn't matter what flavor you come in. See, if you speak to any VC, he'll say by the time he starts raising his fund, about to close his fund, starts deploying his fund and ending his fund, his thesis would have changed 6 times over. We've had the same thesis and the same 5 focus areas of technology and technology-enabled companies since we started as a 50 crore fund in 2016. That's actually held us in very good stead throughout the entire time because good businesses are eternal. The rest of it is just marketing BS. Skip the marketing BS. Come up with a good company. We will reverse engineer a thesis to end up actually fitting that. That's actually the hallmark of a VC.
Shanti, there's so many more themes playing out now. There's AI, there's EV, there's, all of this green tech. And of course, when you talk about India as a growing economy, the consumer theme is always at play. You look at the Coldplay tickets being sold out like crazy, those experiences that people are building, platforms on that. What are you looking at as the new buzzing sectors?
So the sectors we see on the platform is basically consumer, and fintech I think is evergreen. I think fintech has not even seen the start of innovation in India today, right? So I think fintech, we are seeing health tech. I would see emerging kind of trends we are seeing is in manufacturing, right? We are seeing, I would call it industry 4.0, which is basically intelligent robots, AI, a lot of deep AI, like good solutions in AI, and not just wrappers and not just applications, right? People are actually innovating, creating a lot more innovations around that.
Yeah.
And I think, and like what Siddharth said, that is the way you evaluate a company, right? At the end of the day, a lot of VCs do have sector focus, right? So I want to just look at AI and deep tech because our ability to evaluate technology has to be a lot more. When you're seeing a lot of companies in the space, you should have the ability to evaluate that sector a lot more deeply.
Okay. And just a question to wrap up in terms of the lessons that we can learn from the big headwinds that we've seen in the past year in this space, from the edtech space, one of the most valued companies due to corporate governance issues, not mincing words, Byju's over there. And then we saw the entire regulatory crackdown on Paytm. So, and these were the biggest and the most valued companies of the country. So what are the lessons and takeaways for both founders as well as investors?
I think the biggest thing for founders especially is to actually run a good business. I think, see, a large amount of time, capital has been a fantastic fig leaf and like Ganga Jal to baptize all the sins that a company has actually had for that matter. But the moment the capital actually runs out, everyone knows who's actually been swimming naked. And has become painfully apparent over the last couple of years. Number of corporate governance questions we had to end up facing when we closed our fund out in a quarter last year was huge. But because we ended up actually emphasizing the fact that corporate governance is like personal hygiene. If you do it well, no one notices. If you do it badly, nothing can actually hide that stink. As simple as that. And that's actually held us a good stead. And it's held very good quality founders in good stead as well. So for founders, just the only thing is just make sure you run a good business. Everything else ends up actually falling in place. And of course, have patience. Everyone wants to be a unicorn in 2 years for that matter. It takes you 2 years to reach a unicorn. It takes you a month to end up actually losing that status and dissolving all value. And to investors, I think the important thing is understand that the capital that you end up actually putting in does end up actually having a price attached. You can't end up overpricing assets just because you want to be competitive and end up getting into a company. At one point, you naturally overpay years and years of growth and you end up discounting it as of now. The company may never be able to succeed. And lastly, don't get high on your own supply. A lot of them end up raising multi-billion-dollar funds. When you have 1, 2, 3 billion to end up deploying, the absorption capacity in the early stage isn't enough. You start creating inflation. It's textbook venture inflation that happened. And it's not just them, but the entire ecosystem has actually suffered. They can write it off and say, India's bad, whatever, I'll go to Southeast Asia, I'll go here, I'll go there, and come back. But the rest of us are actually left with the pooch that's screwed. So even founders need to say, look, my business needs so much, compete for the amount of capital that you need. Valuation is always reverse engineered based on the capital that you require. So I think keep that in mind, and investors keep that in mind. We will stop seeing the booms and busts that have actually predicated the last, not even 10 years, the last 5 years for that matter.
Just two things here. I think Siddharth has summarized most of it. But one is there is no shortcut to success, right? I think there is no way you can build a very good company very quickly. There will be some breakages there, that is one. And second is just to founders who have raised capital. I think you have to remember you are the guardian of that capital, right? And you have to be responsible for your ethically, integrity-wise, just for managing that capital from a governance perspective. There are absolutely zero excuses there. You can't say, I didn't know it happened, because finally the buck stops at you. And you have to know that you have to return that capital and you are working for your shareholder wealth. And I see a lot of founders, when the company starts doing well, they want to pivot, they want to create another company, they want to move the IP from here to there because they don't want to pay back the capital. I think a lot of that is happening even at early stage, right? So I think that is something which I think founders should know, that once you've raised capital, you are on the treadmill and you have to return.
Be actual engineers, not financial engineers.
Closing, quick take questions to you. Question, what would be on your anti-portfolio?
Sorry?
Any startup that would be on your anti-portfolio?
It would be or is?
Is.
They
Or you
are.
think it's-
Thankfully, I think some of them are not doing as well. It's unfortunate, but it's Schadenfreude. Some of them are not doing that well as. I'm not going to take names, but we did see a number of them that we kicked ourselves for missing in 2021, and we're thanking God that we actually missed them in
Which
2024.
space?
EdTech.
EdTech. Okay, Shanti, to you, what would you consider in a startup investor or in a startup when you look in order of preference, when you look for investment? Founder's mindset, product market fit, tech and innovation, or a business model?
Founder mindset.
That would be your
Founder will
first.
figure it out.
Yeah.
Smart founders always figure it out.
Okay. Thank you so much for your time and, of course, all the perspective that you got.